Well, what is up, everyone? Another tutorial video here if you are new. I know that I said that I'll be uploading them every day, but as always, I struggle to stick to a schedule, but here we are. We have a really interesting topic today that I'm sure almost every single one of you is going to benefit from greatly. So we have a lot to unpack here, but first I'm going to go over a story. So years and years ago, a little over 6 years ago when I first got into trading, the person that kind of introduced me to the whole game, who isn't trading anymore, by the way, but the person that introduced me to the game, they had a strategy that they were trading profitably at the time. But that strategy did not involve using stop losses. Now, there are a lot of profitable strategies and a lot of profitable algorithms that don't use stop losses, but for the most part, if you're a manual trader and you trade intraday, not using a stop loss and not having an exact invalidation and trading with momentum can be quite dangerous. And for the most part, those people end up going bust and not making any money. So when I was first unpacking this person's strategy, when they were teaching me about what they were doing, they made a very important point. And this point was actually the pivotal moment that sent me in the direction that brought me to my strategy and where I am today. And what did that person say to me? I asked them, why don't you use a stop loss when you enter a trade? And they said to me, because every time that they place an order with a stop loss, their stop loss gets hit and then price moves in the direction that they thought it was going to move. And I asked them every single time, and their response to me was yes, every single time. So I responded, if this happens every single time, why are you not taking advantage of that happening? And they were just staring at me with a blank face. So I took it upon myself to go searching on the internet, studying the charts, spending years and years every single day, unpacking what they told me and trying to reverse engineer how the market works. So if the majority of people are placing a stop loss and the majority of the time that stop loss gets hit and then price continues in the direction that they thought it was going to continue in, how does that happen? And how can we take advantage of that happening? And that eventually led me to the fact that the markets are in fact manipulated and that the majority of traders do lose money. But this is a good thing, because if the market is manipulated, then surely the people or the entities manipulating the market are using a system. If they are using a system, that means that we can reverse engineer that system and create something of our own that piggybacks what they're doing. And that is the easy and easy out strategy. So the idea isn't to predict necessarily where the manipulation is going to occur. The idea is just to react once it happens. So I have something here, a video. This is the CEO of Alameda, one of the biggest market making firms in crypto. Now you guys can go and research them yourself. I'm sure a lot of you know who they are, but here is a video that they released not too long ago, and this is the CEO. So let me just bring this up here and you guys can listen to that. So listen to this.
Yeah, we don't really do any technical analysis except as it relates to thinking about how other participants in the market may be doing technical analysis and how that will affect their behavior.
And again.
Yeah, we don't really do any technical analysis except as it relates to thinking about how other participants in the market may be doing technical analysis and how that will affect their behavior.
So, one sec. There are a few other examples of this. This doesn't only happen in crypto. This happens in the traditional markets as well. And I'll post a few links of some market makers talking about what their job involves. And a lot of them, they're not, for the most part, they aren't really looking at technical analysis. However, they do take it into account, and they do at times use technical analysis to see where the majority of the retail traders will be entering, and they use that to their advantage at times. I'm not saying that they're looking at your $100 stop loss and trying to engineer liquidity based on that, but there are times when they could take advantage of what others are doing. So like I said, the idea isn't to predict if they're going to manipulate the market. The idea is to react once you do see that manipulation. So that's what we'll go over here today. All right, let's get stuck into it. So ask yourself, would my stop loss be a good entry? If the answer is yes, wait for price to reach that zone and see if an entry trigger forms. Like I said, the idea isn't to predict, the idea is to react. So the entire strategy, if you guys aren't aware and you haven't seen any of my videos, make sure you go and check them out. But the entire strategy itself is based on one pattern and one pattern only. And what is that pattern? Essentially, I wait for a low to form. Once the low forms, I wait for that low to be swept. Once that low is swept, I then wait for price to break up above the high that swept that low. Once we get that break, I then look for the same pattern to form again between the high and the low. Then once we get it, so a sweep, a break, then that is my entry trigger. Now, I'm not just entering on this pattern blindly. Before I do enter, there's always some kind of context that goes into it, okay? And the patterns here that I'm going to go over here in a sec are a way for you to provide or build a little bit more context. And if you go watch the previous episode where I spoke about the KSRP, that's also another way for you to build some context. So the first thing that you need to do is kind of have an idea of where these liquidity pockets may reside. So there's a few spots above key swing highs or below double bottoms, for example. So we wait for price to reach into these liquidity pockets. Once we reach into them, then we look for the pattern to form. So if we have a key swing high, above this key swing high, you have traders getting short from this point, thinking that price is going to go down and that this is an area of resistance. So traders are going short here with their stop loss in this zone. And then you have another set of traders that are waiting for a breakout above this resistance, thinking it's going to be turn support. Now they're entering. So with the two kinds of traders here, the one that's entering short and then the one that's trading the breakout here, we now have a liquidity pocket. The idea isn't to predict if price is going to continue to break up or if it's going to break down. The idea is to wait for the pattern to form. Once it does form, then you can look to take advantage of the manipulation. What is happening here, if you see this pattern form inside of a liquidity pocket, what is happening is that these orders here are being used as liquidity for the larger players to enter their positions. Okay, so the idea isn't to predict, it's to react. So this is an example of a key swing high. And then here is an example of a double bottom. So we have a swing low forms, we come up, we form another swing low, we come up again. We break below this double bottom. So now we've got two kinds of traders. We've got the people that are entering long here with their stop loss right below. And then we have the other traders that are waiting for a break of this support and assuming it is an SR flip where they'll then be entering short. So now, just like this example, we have a liquidity pocket. Like I said, the idea isn't to predict if we're going to continue down. The idea is to wait to see if we form this pattern and then we react. And then we have the traditional technical analysis patterns like a bull flag. So let's say we have some accumulation here. We form the double bottom. All of the liquidity here was used to fill the larger players' long orders. We then continue up. Okay, so now we've got reason to believe that this is bullish. Price then starts to form a bull flag. Okay, we shoot up from the bull flag and then we break down. So now we have traders trapped in their longs here and they're now being stopped. So if you go long on the break of a bull flag, your stop's going to be below here. Okay, so we've got liquidity from those guys. Then we run down. Now we have people thinking that this is a break in structure and we're going to reverse. So now we have people shorting and we have the stop loss from the people that went long here. Again, the idea isn't to predict, the idea is to react. I'm not saying that bull flags never work out as they're traditionally meant to, or that double bottoms or double tops never work out as they're traditionally meant to. What I'm saying is that developing an edge around trading bull flags or around trading double bottoms statistically doesn't work. So what does work is developing an edge around these patterns actually failing and then adding the confirmation or the entry trigger with that. Okay, and that's what we're doing here. So yes, bull flags will work, but I don't trade them personally. My edge is waiting for them to fail, okay, and then waiting for the proof that larger players are banking on them failing. So we see the false breakout, the move down, the liquidity being used up here, and then we shoot up. So if you guys want to go look in the charts, you'll see the double bottoms failing and then price shooting up. You'll see the bull flags failing, the bull flag forming, shooting up, and then breaking down just for it to continue up. Okay. So I'm going to cut that here. I know I haven't gone over any examples and I haven't explained anything too much, but I'm going to leave this up to you to go into the charts and find these scenarios play out themselves. Look for the double tops, wait for price to reach above them and start to sell off, as in start to see this pattern. Wait for a double bottom, wait for the pattern to form. Look for the bull flags, wait for the pattern to form. Rather than entering where people traditionally tell you to enter, wait for the pattern to form and wait for traders to get fucked, because that is where the opportunity is. Whenever you look at any chart in any market, your first thought should be, who is fucked and where can they cause the most pain? This is how the markets really move. You have to think to yourself, when you find the areas where traders are most fucked, that is where the most liquidity is residing. And this is what makes the most sense. If liquidity is sitting in a certain area, that's demand in a market. Markets will move to where orders are. All right, so I'm going to end that one here. If you guys have any questions, you can leave them in the comments, and we have the free Discord as well, where I share my entire strategy, all of my strategy documents, all free for you all. No worries, guys. Enjoy the rest of your day. Bye.